It's Monday the 5th. Good morning. On the agenda, Trump talks Venezuela, gold rises, oil falls, and Asian tech surges into 2026, Tom.
Gains of around 3% for the Kospi over in South Korea. That gauge, of course, in terms of the AI sentiment. The Nikkei over in Japan gaining as well, around 3%. You're seeing that then feeding into the broader Asian indexes. The MSCI Asia Pacific, the strongest start to the year for quite some time. At record highs, getting 1.6% on that regional benchmark. The S&P E-minis then also pointing to gains. European futures up significantly so far, so set for a very strong session here in Europe. S&P E-minis pointing higher by 0.2%. And you had the divergence on Friday in terms of semiconductors versus software. Software down in the US, semiconductors gaining, and that is feeding into the Asian session and the optimism we're seeing in terms of the futures picture as well. In the oil space, of course, with all eyes on the remarkable events in Venezuela, currently Brent down 0.6%. The countdown to the opening trade starts right now.
We need total access. We need access to the oil and to other things in their country that allow us to rebuild their country.
President Trump there speaking about Venezuela, of course, over the weekend. Welcome to the opening trade, everybody. Let's get into things. 2026 has started, and it started really fast. The markets are not all about Venezuela. There is an element of that, and we will talk about that. But the markets are about other things as well. They're about AI, they're about the tech trade. But let's do justice to the Venezuela story and then move on, perhaps. We are seeing some movement into havens. So gold is higher, silver is higher, really flexing their muscles as those havens. Gold is, the dollar is also higher, which is an interesting one, given all of the developments over the last year or so and the role that the dollar has played. But we do understand a little bit more about what the US running Venezuela means over the last 24 hours. It's not Iraq. It is running the country via the vice president, who has now reached out to the United States to ask for cooperation. That seems to be the way things are going.
So what do you do this morning? What do you do with this? Trump's New World Order. That's basically the trade going into 2026. Does it imply higher geopolitical risk? Yeah, it seems to. Gold maybe signalling that. Does it imply that we are going to be seeing more interventionist policy going forward? Yeah, probably. Commodities broadly, I think, are signalling that as well. But what do you do with this as a trader? John Arthur says you can ignore it this morning. Can you, is the question.
Well, the lessons from 2025 was that you could look through those geopolitical events, of which, of course, there were many, whether it was Israel and Gaza or Iran or other aspects that came into it in terms of the US-China trade tensions that, of course, hit almost rock bottom last year and have now stabilised. All of those geopolitical events, markets were able to look through, and the analysts seem to be thinking, and the futures are pointing to further gains in the session when it comes to equities. The dollar, though, as Anna was saying, gaining on that safe haven move.
Venezuela's got a lot of oil, OK? I think we all know that. Doesn't have a lot of oil to sell, and that is the issue that I think the markets are now grappling with. So we've got lots of oil. It's going to take years to up production. It's part of OPEC Plus. There's lots of reasons why you're not going to see a lot of crude coming onto the market. I think you're probably going to see a good day for some of the US oil companies. I think that probably is going to be something that is going to happen. But the effect on the oil market seems quite limited this morning. And
the movement in the oil price quite limited, and to the downside. So the market treating this as a supply increase perhaps in the future, if at all, you know, given the scale of the move, not enormous. It's not treating this as a geopolitical tension that is going to reduce supply in the short term and therefore pushing oil prices higher. And I suppose this all comes in the context of what we saw from OPEC Plus over the weekend. They've decided to not change their production quotas right now, and so the story remains one of strong supply for the oil markets, and that seems to sort of ride roughshod over the other narrative around Venezuela.
And some would argue oversupply in the oil markets. Bloomberg Economics, in terms of how they're looking potentially, and this points to both of your focus on the infrastructure needs in Venezuela. Yes, the world's largest supplies, reserves, but getting them out of the ground and shipping them is a very different question. Bloomberg Economics saying that a multi-year recovery for Venezuelan oil production could entail a 4% decline in global oil prices over time. But that's with lots of caveats, of course, in terms of the investment needed.
The thing is, oil prices, will they be materially lower going into the midterms? Because Trump, that's what Trump needs. And you could argue that this is part of this whole narrative. Are we going to see significantly lower oil prices? Can he get oil prices down to $50 a barrel. Can he get oil prices, gasoline prices significantly lower?
Meanwhile, markets are about other things than Venezuela today, aren't they? They're about tech, they're about AI, a little bit of catch-up going on in some Asian markets, but futures here in Europe and in the United States pointing a little bit higher, certainly in Europe. Equities did really well over the last few days, and futures pointing higher, Tom.
A really important upgrade for TSMC as well, and that's lifting the sentiment in Asia. Goldman Sachs raising their price target more than 30% for TSMC, of course, the major foundry when it comes to producing chips for Apple and Nvidia. Talking of Nvidia, of course, Jensen Huang, the press conference ahead of the CES, of course, and that will be later today in terms of the press conference of Jensen Huang. I can't really overstate how important that is, obviously, in terms of the role that he plays, but in terms of setting up the thematics, in terms of setting up the narrative around AI and the drivers for 2026.
The good news is we've got Tom here.
Yes,
now
permanently
in that chair to do tech for us. I can basically park tech now.
I've somehow managed to carve open a space and join this celebrated team. So thank you for having me, at least for now. We'll see how long it lasts. Hopefully,
the tech coverage is going to be good.
You'll have plenty of opportunity this week, won't we? CES in focus, as you said. I understand they're going to clear a whole floor for robotics.
So I think embedded AI is going to be a key theme, and whether or not we move in terms of consumer AI away from just the chatbots, not just the chatbots, but in terms of how we're using on hardware, in terms of watches, eyeglasses, of course,
maybe even
and robotics.
Human form standing robotic AI,
and Ed Ludlow.
Actually, maybe that's what we need. That's the potential replacement.
That replaces all three of us.
That's the future.
At some point. But for now, we're pleased to have Tom.
Now, thank you for that temporary reprieve.
But whilst we're all still here, we're very pleased we've got Tom. Lots to talk about then with all of our guests this morning. We will be talking about the global macro economy. Jennifer McEwen joins us, Capital Economics Chief European Economist. How do we factor in all of the developments over the weekend, the short-term and the long-term regime shifts that we need to think about? How do you factor that in as an economist? Andrew Sheets will be with us, Morgan Stanley Global Head of Fixed Income Research. What does risk premium look like right now? Jerry Fowler, UBS Investment Bank, Head of Global Derivatives, European Equity Strategy with us. Equity market focus could be on the banking sector, as Guy said, looking at Chevron, looking at Repsol, looking at Eni at the start of European trade. We'll also take a deeper dive into the Venezuela story, of course. Ole Hansen joins us, Saxo Bank's Commodity Strategy Head. Just how long does it take to reinvigorate the Venezuelan oil industry? We'll ask him about that. And Robin Nibbler will be with us, Chatham House Distinguished Fellow and former Chief Executive, to talk about what on earth this all means, this new mode of operation for the US administration when it comes to international affairs. What does it mean for Venezuela, for the Americas, for the Western Hemisphere, for Greenland, for China, for a whole host of other places?
Yeah, the Danes coming out, of course, and warning the US, or at least putting out statements saying you cannot annex Danish territory. Of course, a nod there to what they've been saying, the US, about Greenland. Here's what else to be thinking about this week, then. We have CES, of course, as we mentioned, in Las Vegas, officially kicking off on Tuesday. But, of course, the press conference with Jensen Huang today will be in focus, as we mentioned. On Tuesday, French and German CPI, so inflation prints, of course, out of those key drivers of the Eurozone. On Wednesday, Euro area CPI, more generally, US JOLTS, of course, job openings, and ISM data on services sector. So a flurry of data through in terms of Europe and the US, building up to non-farm payrolls on Friday. On Thursday, you get those jobless claims before you get NFPs on Friday, and then you get NFPs on Friday. So a lot of jobs data out of this give us a lot more clarity in terms of what is happening, given the still uncertain picture when it comes to the US labour market. You also get inflation data out of China as well, which is staying and stuck in deflation for a little over 3 years. But non-farm payrolls, we'll get some clarity. The survey is around, 59,000 in terms of the month of December for non-farm payrolls, dropping on Friday. The expectation is the unemployment rate will actually come off a little bit from 4.6% in November to 4.5%. Bloomberg Economics has a slightly different view, but that is the Bloomberg survey. 59,000 is the number they're looking for.
Does it matter for January for the Fed? I mean, the bond markets are not pricing in a Fed. They're not pricing in any cuts until June. In fact, now, just as a quick early start of the year recap, and what we're pricing in June is when we're now pricing in the next Fed rate cut. So not this month.
Here we go. Here's the debate. Do I need to worry about the labour market? Do I need to worry about inflation? Which one of those two take precedence in 2026? Which way will the Fed lean? We're getting a slightly more hawkish Fed composition coming in, but we're about to get a new Fed chair. I don't know yet.
I feel like by Friday we might feel like we've worked an entire year
Well, we'll have some data to work with, which is a bit of a novelty. What else do we need to know this Monday morning? Denmark's Prime Minister has urged President Trump to stop threatening to take control of Greenland. Yesterday, Trump once again said that the US needs the island for, quote, defensive purposes. Prime Minister Mette Frederiksen said the US has no right to annex any of the 3 countries of the Kingdom of Denmark. President Trump has argued that the US's control of the territory is, though, necessary.
We need Greenland from a national security situation. It's so strategic. Right now, Greenland is covered with Russian and Chinese ships all over the place. We need Greenland from the standpoint of national security. And Denmark is not going to be able to do it, I can tell you.
German authorities suspect a left-wing group is behind a power outage in southwest Berlin that has left nearly 50,000 households and 2,000 businesses without electricity and heating in freezing temperatures. A group called Vulcan claimed responsibility for the attack, saying its aim was the fossil fuel economy. The outage is expected to last until Thursday. And Ukraine's President Zelensky says US negotiators will join European leaders in Paris on Tuesday in the latest effort to hash out a post-war security guarantee for the country. The Ukrainian leader said there will also be meetings with President Trump's team, adding that Kyiv hopes to set up a meeting with the US in the US between the leaders by the end of January.
10 minutes past 7 here in London. Coming up on the programme, coming up on the opening trade, we will see how oil companies are reacting to the news out of Venezuela at the open. Perhaps not so much Shell and BP, perhaps more Repsol and Eni, but we'll certainly keep a focus on that. Plus, with metals continuing to surge, we'll have our eye on all assets moving in the wake of the latest events. Up next, we'll check in on the latest movements in global markets. If you have any questions, if you want to get involved in any of these start-of-the-year conversations around this desk, then please do get in touch with the opening trade team. IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg.
I think it sends a powerful deterrent signal to international regimes like the Chinese, the Russians, the North Koreans, the Iranians, that the United States will not tolerate trying to trample that international order.
And this is about power and control, and it's shocking how quickly and easily this administration is willing to slough off the actual law and to disregard it.
I think they are preparing the chessboard for the great geopolitical contest of our time, which is between emergent rising superpowers, and they are wanting to grab as much power and influence as they can in the Western Hemisphere. And I think Vladimir Putin will be the one in his mind taking some credit for giving Trump the idea that this can be a new imperial age. New world order, but with heavy doses of the old world of empires.
Some reactions there from this weekend's events. Some of the guests on Bloomberg TV reacting to the short-term implications and, no doubt, very much the long-term implications of what we've seen by the United States in Venezuela. Let's take this from a markets perspective, though. Bloomberg's Valerie Teitel is with us once again in 2026 to talk us through her thinking here. And, Val, when we look at this from a markets perspective, we've read a couple of reports this morning saying, it's not really touching the sides for markets. Yes, we've got an oil price a little on the move. Yes, we've got some money going into havens. But this does seem something that the markets wants to process quite quickly and put to one side.
Now, at least for the equity market, it seems to tell us a narrative that if it doesn't impact the AI trade, I'm not so sure how much it matters for the long-term picture of global equity markets. We are up nearly 0.5% already on NASDAQ futures to start this Monday morning, and it was a very strong session yet again in Asia. We had the MSCI Asia Pacific notching a new record, and the chip makers are continuing their outperformance. Samsung up some 7%, TSMC up over 5%, and this was a big theme of the markets on Friday. Yes, tech was a bit volatile in the session. The NASDAQ ended in the red. But we saw chip makers perform very strongly versus software makers. And this discussion all goes down to where you want to place yourself in the AI trade. Do you want to be upstream or downstream? It does seem to be like chip makers are starting the year on a very positive footing and software makers on a negative footing. Now, we do hear from two big chip makers later today out in Las Vegas. The Nvidia CEO and the AMD CEO are going going to be speaking out in Las Vegas later today. It will be interesting to see if they have any comments on the recent China IPOs of chip makers. We had one of those on Friday that posted triple-digit gains out of the gates and follows a string of some pretty serious IPOs out of Hong Kong.
Back on Venezuela, are there any local assets that you're monitoring when it comes to that economy and that jurisdiction that are showing the sentiment change there?
Look, it will be interesting to monitor the fixed income side of the Venezuela. Now, I have to preface this with that these assets are very illiquid. There's not a lot of volume that trades in this kind of frontier markets of Venezuelan bonds. But it could give us a kind of a decent sentiment indicator of how much belief there is in the market that this leadership change will change into an economic, renaissance or an economic change for Venezuela. Now, some of these bonds, Venezuela has around $150 billion worth of debt. Some of these dollar bonds have already doubled since the U.S. started ramping up pressure, but they still continue to trade very at distressed levels, around 30 cents on the dollar. There is some discussion that they could trade all the way up to recovery value around 60 cents on the dollar, and that would really be down to how quickly they can get this oil out of the ground.
We're going to watch that one very closely. Valerie, thank you very much indeed. Valerie Totel. Let's carry on the conversation. Jennifer McEwen, Chief Global Economist at Capital Economics, joining us around the table this Monday morning. Good morning. Happy New Year.
Hello. Thank you. You too.
Does Venezuela change anything?
In Venezuela, absolutely. But from a global economy perspective, I don't think it really does move the needle. Venezuela, back in the 1970s, accounted for about 1% of world GDP. Now it's about 0.1% of world GDP, so very small. And even if we just think about the oil market, which is where most economists' minds will turn initially, previously it had produced about 8% of the world's oil, and now we're looking at about 1%. So it's not big enough, really, to move the needle.
So there's two key themes this morning, one of which is Venezuela and the oil market. The other one is the fact that Asian tech is going crazy again, and we've got huge gains being generated on a number of markets out there. Is this year going to be about big tech spend? Is this year going to continue to be about the AI trading, the amount of money that keeps being pumped into it? Is that what does drive your models this year?
Yes, I think it does, really. I definitely think this rally has a bit further to run. We're forecasting the S&P 500 to rise.
But just in terms of the economics, the spending, just kind of the sheer volume, the amount of money that seems to be being poured into this trade has an economic effect. I'm not sure how big the trickle-down is, but is that what keeps the US economy, the global economy, moving in the way that it has been?
I think it is. And in terms of the macroeconomy, you'll see it in earnings and in earnings projections and everywhere. But in terms of the macroeconomy, this has only just got started. This investment has only really started in 2025, and there's a lot further to run. Even after the equity market adjusts, which I think inevitably it will do at some point, then you could still continue to see some really significant macroeconomic effects, both in terms of investment and productivity, which of course comes later once the benefits of this.
I was going to ask you that, actually, Jennifer. So to the extent that you're factoring in the AI impact into the US economy and your expectations there, that's all about investment and capex, is it? It's not actually about the productivity gains yet. That's still another leg that we have to look ahead to.
You're right. That's the next leg. And I think we could well start to see that during 2026, that productivity gains start to materialise, and perhaps we start to see AI's impacts broaden beyond just directly the tech sector and more into perhaps healthcare, financial services, areas where it's most obvious that AI can create some efficiency gains.
Yes, and one of the things of 2025 was clearly trade tensions. That seemed to get pushed to the sidelines as we went through the year. The market started to look through that. But you remind us in your notes ahead of this conversation this morning that those tensions have not gone away entirely. And just a truce between the US and China, given the geopolitical tensions we've seen demonstrated over recent days, they could come back. Those tensions could come back. They could be expressed once again through trade.
Yes, I think they're likely to, actually. We know that the US-China trade deal took away some of the immediate risks, certainly some of the immediate risk of a renewed escalation in the trade war, but those fundamental problems have absolutely not gone away, and they're not going to go away. And we know that we have a sunset clause in the US trade deal, the US-China trade deal, which means that that's going to be up for renegotiation again later this year. We have meetings coming up even earlier this year, which could cause trigger points around the trade tensions. So.
Well, it kind of brings me back to the Venezuela question when we think about China and just how much it's been buying from Venezuela, the largest buyer by some margin. How easy is it for China to find alternative sources of oil if those become more restricted?
Not that difficult, I don't think. Although China is the major buyer of Venezuelan oil, if you look at it as a share of China's overall oil supply, it's still very small because Venezuela is a small supplier. So I think it could cause some tensions. It could cause some disturbance as China adjusts to this. But I don't think it's I don't think it's that big a deal. And actually, Venezuela's oil infrastructure hasn't been damaged so far as we know, so it may be that under a new leadership, Venezuela can continue to export the oil that it has.
We're getting a lot of jobs data out of the US this week. Do you expect to have a clear steer by the end of Friday in terms of how the labour market in the US is evolving?
A clearer steer, for sure. We know that recent data have been very, very difficult to read, given the shutdown and the distortions that's caused. I think that on Friday we'll probably see about a 60,000 gain in non-farm payrolls, so soft but not disastrous, and we are expecting the unemployment rate to come down a bit. There were some temporary layoffs around the shutdown, and we think that as that goes away, that those problems will ease to some extent. So an OK jobs report, I think.
The real question is, though, if the AI trade is, if the capex story is accelerating, and you continue to see that into the beginning of shouldn't the US economy be accelerating at this point? Like, is the labour market going to be the problem? Isn't the labour market going to get better from here? I know we've seen a slowdown, but that's the real challenge in 2026, isn't it? Trying to work out whether the AI trade is big enough to kind of keep the rest of the economy on track and keep the labour market on board.
I think that comes back to the productivity question that Jennifer and Anna were talking about.
But that seems to come much later.
Well, potentially it comes later, but also the uncertainty in terms of what that productivity gain means for jobs. Because as you've discussed previously, towards the end of last year, Guy, you were talking about the fact that this capex is fairly jobs light. You can build a data centre with a small number of people, so it's not really changing the labour market dynamics significantly, seems to be the take. But does the productivity gains come through, if they come through this year or next?
Yes.
How does that change the labour market dynamics? That debate is still live.
We talked about this and how the Fed deals with this. If their two mandates diverge, Jennifer, if this economy booms, to Guy's point of where the AI and everything, but the jobs market is weak, and those two, there will be political pressure to focus on jobs, I imagine. How are you thinking about the way that those two mandates will interact this year?
Yes, that's right. I think one thing to bear in mind about the softness of jobs is that it's partly supply-driven. It's about
there's not a huge amount of migration coming in, is there? So.
Yeah, exactly. So that means the labour market is not weakening in the way that would bring down wage growth to some extent. You don't have this large pool of unused labour, so it's not like we're seeing significant disinflationary pressure from this trend. I think the labour market probably will pick up a bit over the course of next year, but this immigration kind of pull will mean that you don't see large jobs gains.
So inflation's been easing. We'll see what happens with jobs at the end of this week. It's been mixed, obviously, and growth has been higher. And we saw that in the last quarter of last year. So where does that leave the Fed?
Yeah, well, I think at the moment the Fed is very finely balanced, and actually we're seeing this across central banks. If you read the minutes, if you read their communications, there's a lot of talk about things being finely balanced, about as you're approaching something like a neutral or equilibrium interest rate, the decisions become more difficult, and I think that's where the Fed is at the moment. But I think as we go through this year, it's going to be the case that the Fed starts to focus less on the softness of employment. That starts to pick up a bit, and it's clear that that's not causing a major disinflationary impact, and a bit more on the continued stickiness of inflation, which we're still seeing in survey measures like the services ISM, for example.
OK. Jennifer?
Yeah.
Thank you very much.
That's Jennifer.
Yeah. You look like you're about to jump in, Guy. No. Jennifer, Guy, Anna, thank you all so much. Jennifer, thank you. McEwen, Chief Global Economist at Capital Economics. Coming up, we're going to dive deeper into the global implications of Trump's ousting, of course, of Maduro. More on the geopolitical impacts. That is coming up. This is Bloomberg.
Monday the 5th, good morning. 30 minutes to go until the opening trade here in Europe. Futures are positive. Asian tech is having a very, very good morning. Names like TSMC and Samsung are doing well. It's CES in Vegas this week. Look for European tech names, therefore, to maybe have a strong start. And we're going to watch very carefully what happens with the oil trade as well. What does it mean for European oil producers, Tom?
Yeah, the likes of ASML is going to be really interesting on the back of the TSMC upgrade from Goldman Sachs. We'll check in on the bonds then. There's a very modest bid for US Treasuries right now. The dollar is stronger. The benchmark US 10 year is currently yielding at 4.18, very modestly gaining then a gain of 1 basis point on the 5-year, and the 2 years largely unchanged at 3.46. Just a reminder, of course, that markets expect around 2 cuts from the Fed this year. The dot plots, of course, have 1 penciled in. We did hear from Anna Paulson of the Fed suggesting there is room for further moves lower in rates with some conditionality there. In terms of European bonds, the French OAT is currently largely unchanged at 361. The Italians are at 361 as well, largely unchanged there. And not a lot of movement in terms of European sovereign debt. We'll see how that changes with inflation data out through this week as well. 290 right now on the benchmark German 10-year.
Let's get an update then on the latest on Venezuela. President Donald Trump says the US needs, quote, total access to Venezuela and its oil to rebuild the country following the capture of President Nicolás Maduro. The US swooped into Caracas over the weekend, seizing Maduro and flying him to New York to face drugs and weapons charges.
We need total access. We need access to the oil and to other things in their country that allow us to rebuild their country.
In a statement on Sunday, Venezuela's acting president, Delcy Rodriguez, invited the US to work together on a cooperation agenda. For more, let's bring in Bloomberg's Rosalind Matheson, who's been tracking the story for us, of course. Ros, very good morning to you from London. So President Trump said the US plans to run Venezuela. We're getting a bit more of a sense as to what that means. This doesn't look quite, it's not like Iraq, perhaps not boots on the ground, administration on the ground, but maybe running this country via its vice president remotely.
Well, that's right. So running does imply a bit of a business agenda, and Donald Trump does like to blur the lines between politics and business. But as you said, this is seemingly really more about making sure the US priorities are being adhered to, enacted by whoever's in charge in Venezuela, less about trying to get a different kind of government in. I mean, they've not really said anything beyond the idea of removing Maduro to have any other kind of fundamental change in the machinery there, or to have elections, or to have, as you say, US troops on the ground. But this seems to be more about having a policy agenda that they want whoever's in charge in Venezuela to help enact, and that's particularly around curtailing any flow of drugs from Venezuela through into the US, and also to make sure that the US essentially gets control of Venezuela's very valuable energy sector, its oil industry, especially over the long term. So those seem to be the 2 key policy priorities there for the US, and a reluctance really to go much deeper than that. But of course, things are pretty chaotic in Venezuela at the moment. The situation is very delicate. We don't really know if Rodriguez will be able to stay in control, and if things do descend into chaos, does that pull the US in, even militarily, despite Donald Trump's desire to avoid that, at least for now?
Ros, just hold that thought for a moment, because the big question I think a lot of people in Europe are asking this morning is Greenland next? Let's listen to Trump on that matter.
We need Greenland from a national security situation. It's so strategic. Right now, Greenland is covered with Russian and Chinese ships all over the place. We need Greenland from the standpoint of national security. And Denmark is not going to be able to do it, I can tell you.
So it sounds like Trump wants Greenland. Like, I could be wrong about that, but I think it probably sounds like he wants Greenland. So, Ros, is Greenland next?
Well, that's the question. To what degree does he want Greenland? Because he's had his eye on it since well before Venezuela. But it's all part of this pattern of the periphery, really, of the US. I mean, Panama, Venezuela, Mexico, Canada. He's joked about becoming another US state. But clearly he looks at Greenland, which he says is quite close to the US. And he says it's essential to the US for its security in the Arctic. And also, handily, it comes with a whole lot of natural resources. But what does he mean by taking it or running it? Does he he mean simply, again, that he wants US to be prioritized there when it comes to access to natural resources for US businesses? Does he want a bigger military footprint in Greenland for the US, the ability to really use Greenland to leverage its security goals in the Arctic? Or does he mean something more profound, more deeper? Because, of course, Greenland is a very different question than Venezuela. We're talking about countries that have elected democracies, functioning democracies. These are not dictatorships where you're going in to remove a leader who's repressive and unpopular. These are democracies, and it's much more complex. But does he simply mean, does he want Greenland, Canada, Mexico, Panama to deliver on what he sees as US policy goals? And he'll threaten them if they don't. He'll threaten them economically with tariffs and other penalties, and perhaps even from time to time, as he's done with Greenland, he'll moot the idea of perhaps sending troops in. But does he just really mean he wants to have better control there of the natural resources and his security goals?
OK, Bloomberg's Ros Mattison with that update. Ros, thank you very much. So, great power competition seems to be back, a focus certainly on the back of the actions by the US and Venezuela, spheres of influence. So how do you play that as an investor? Let's bring in Andrew Sheets right now, Morgan Stanley's global head of corporate credit research with a view on the fixed income space. Andrew, good morning. Thank you for your time. What does this mean for global fixed income as we think about these realignments that we're starting to see now globally?
Yeah, thanks. Good morning. It's great to be here. So I think we're focused on three things this morning. The first is, as your colleague just mentioned, still a lot of uncertainty about how this plays out. We have something that's both historic and unusual in the developments over the weekend, but something where there's still a lot of very significant questions about where it goes from here and a lot of complexities. I think, secondly, our oil colleagues, and I think the market will naturally look at this from the lens of oil, the financial markets will. We are cautious on oil. We think oil is going to trade weakly. We've thought that for a while. My colleague Martin Ratz has a price target of kind of the mid-50s on oil. And this is a world that's oversupplied already with oil, and the Venezuelan oil is famously difficult to extract. It's heavy, it's sour, it requires significant investment to get out of the ground. So this could increase supply over time, but it's not something we think changes the energy picture significantly. What the energy market already had was an oversupplied market that we think just struggles in the face of that oversupply. And I think, third, the market also has a lot of other things to focus on this week. As you were talking earlier, we have the jobs number. We have an active debate over what the Fed will do next. We have an active debate around the economy. And I think the AI tech trade remains very much in train, as we see with price action in Asia. That's what's driving markets there this morning. So, you know, in total, I think this is something we're going to need to watch. It creates some uncertainty. But I think for the moment, actually, the market's probably going to go into 2026 more focused on the questions around tech, more focused on the questions around the Fed.
When you think about that tech trade then, and this is a line from your notes to us, US equities will outperform US credit substantially on our forecasts. What are the catalysts that you're looking for that will come to bear in 2026 that weren't there in 2025? Yeah,
so in some ways, I think credit has run out of road in terms of where spreads are. And we also think that the credit kind of equity incentives, the dynamics are really starting to shift, right? So one of the most interesting dynamics of credit markets over the last couple of years is, despite what have seemed like quite buoyant financial conditions, you really haven't seen much borrowing and much supply on a relative basis. Leverage has been pretty stable. Debt to GDP in the U.S., corporate debt, has been coming down in the last couple of years. That's starting to shift. We've seen really large upticks in issuance over the last quarter. Tech has been at the leading edge of that, and we think that continues. An area where we're out of consensus at Morgan Stanley is we think there's going to be more issuance in U.S. credit next year, about $1 trillion net of net supply and investment grade next year. And so more supply, more aggressiveness, that kind of starts to shift factors, while the equity market is still supported by earnings growth and a Fed that continues to cut.
So you say credit markets have run out of road a little bit, but part of that's just because the spreads just can't keep narrowing even more, I suppose. But you don't think stocks, and I know this is the bigger Morgan Stanley view than just your department, Andrew, but you don't think stocks have run out of road. And you draw parallels with 97, 98, not 2000, and you draw parallels with 2005, not 07. So we're a couple of years away from a peak.
Yeah, and I think that's the historical context that I think investors can benefit from, right? That you have an environment where we think animal spirits are increasing, where M&A is increasing, where CapEx is increasing, but the economy is still holding up. And in our view, whether quantitatively or qualitatively, in our view, that rhymes a lot with the markets in 97, 98, or in 2005. And 2005, 1998, 1997, all three of those years were years where the S&P was up double digits, and they were all years where investment-grade credit spreads were wider. And so this disconnect can happen. This disconnect can happen when corporates are getting a little bit more aggressive, when animal spirits are flowing through the market in a broader way, and that's a bit how we think 2026 plays out.
Does this get ended by us all worrying about debt again? Because the difference between the dot-com bubble so far has been actually there's been a lot of borrowing, yes, and a lot of debt issuance, a lot of investment in capital expenditure, but it's not been necessarily debt-fueled. But that's changing, perhaps.
It is, but I think what's interesting is the market's rightfully focused on the large amount of spending that's going to happen in the AI infrastructure space, right? We at Morgan Stanley think it's roughly $1 trillion that's going to be spent between now and the end of 2028, which is not that far away. But the companies that are borrowing this money have some of the best balance sheets on the planet. They have very high ratings. And so to your point about what we're watching for, we haven't yet seen borrowing that's taking ratings lower from these companies. We haven't yet seen more speculative borrowing for data centers that don't yet have a tenant, for example. So I think that very well could happen in the future. The nature of cycles is they tend to get more aggressive, but I don't think we're seeing it yet, and that gives us some confidence it can run for longer.
We're going to make more money in the U.S. or out of the U.S.?
We think U.S. equities outperform. And
the rest of the world?
The rest of the world.
Dollar adjusted?
Dollar adjusted. Well, yes, we do. We think the dollar weakens in the first half of the year, but then strengthens in the second half of the year. And that matches a little bit of how we see the economic path. We see the U.S. data a little bit weaker in the first half. Then the U.S. economy is going to be stronger in the second half as more fiscal.
The dollar's at the same place at the end of this year that it was at the end of last year?
Roughly speaking, within a couple of percent.
But FX is not going to be a story this year.
It's going to be a tale of two halves. So I think that it's going to be a case of the dollar's weaker in the first half of the year and stronger in the second. But overall, if you go to sleep today and wake up, it'll be a much less of a story than it was in 2025.
Why are U.S. equities going to outperform the rest of the world?
Well, I think it has a much better earnings story, quite frankly. And again, as we think about excesses and where we are in the cycle and whether or not this is justified, I think a really important part of this whole story is that earnings growth has been good in 2025, and we think that continues into 2026. So, if I talk to my colleague Mike Wilson and our U.S. equity strategy team, our forward earnings growth indicators are very strong. If the Fed is cutting, if the economy is holding up, if earnings are growing, we generally don't think the multiple contracts. And if earnings grow double digits, the U.S. equity market could be up double digits.
Where does that leave Europe then, and the fiscal impulse that's coming through in terms of defence and infrastructure spend, and particularly where it leaves your view on credit? Because I know you've got a bit of a divergent picture in terms of IG performance versus high yield in Europe in 2026.
Yeah, so I would say that the European picture is a little bit more muted from an animal spirits perspective, which is a little bit better for credit, but a little bit less supportive for equities. A little bit less aggressiveness. And it's also, I think, a weaker earnings story. Europe doesn't have the same tech tailwind behind it. If I think about our European equity strategy team, we're forecasting much more modest earnings growth, low single digits in Europe. And, I think you still have a more uncertainty from exactly how long these tariffs remain at elevated levels, that weighing on the European story. So, we still think European equities will be up mid-single digits if we think about the course of this year, but a less enthusiastic rise versus the U.S.
All right.
OK, we're going to leave it there. Great to see you. Second guest of the year, Andrew Sheets. We're keeping count. Andrew Sheets, Global Head of Corporate Credit Research over at Morgan Stanley. What have we got coming up for you? Trump's plan for a U.S.-led revival of Venezuela's oil industry.
We're going to have the big oil companies go in. They're going to fix the infrastructure. They're going to invest money. We're not going to invest anything.
We're going to talk commodities next. This is Bloomberg.
We're going to have our very large United States oil companies, the biggest anywhere in the world, go in, spend billions of dollars, fix the badly broken infrastructure, the oil infrastructure, and start making money for the country.
US President Donald Trump speaking at a press conference on January 3rd about US companies reviving Venezuela's oil industry. And oil is trading a little lower this morning as investors weigh the fallout from the US raid that captured Venezuelan President Nicolás Maduro, of course. For more on the commodities markets, oil and metals, of course, let's bring in Ule Hansen, who's head of commodity strategy at Saxo Bank. Ule, nice to speak to you. Thank you so much for joining us. Lots to talk about then. Let's start with oil. Give us the market's rationale for sending oil prices down 0.9%, 1% in today's session. Does this make sense, and does this look like a sustainable move to you?
Well, good morning and Happy New Year, Anna. Well, I think the market is just trading on the narrative that this ultimately could lead to more supply, and that's why they're trading it from the short side this morning. But I think it's also worth obviously considering that if we do see an increase in supply, that's not going to happen overnight. That may take years before it really starts to build up. So at this point in time, the market's more just trying to get the initial feel for how this could impact. But I think there is in the short term potentially a geopolitical risk premium that we need to take into account as well. Supply from Venezuela is close to zero right now. We have the disruptions, or not disruptions, but we have the riots in Iran, which could be an even bigger case. So with that in mind, I struggle a little bit to see prices being justified below 60 at this point in time, but that's really how the market wants to play it at the start here.
Right. Yes, a lot of uncertainty then around some of the things you described there. But how long does it take to reinvigorate the Venezuelan oil base, Ule? What kind of length of project does that look like to you? Because we've read a lot this morning about how underinvested it is, how much the infrastructure needs upgrading, and perhaps you need a certain kind of oil price to incentivize that kind of investment.
Yeah, and the question is really whether that price we're seeing currently is high enough. I read one of your Bloomberg reports overnight saying that someone basically out saying that the industry probably needs to inject $10 billion on an annual basis for the next 10 years to get anywhere near levels that we saw a couple of decades ago. And that is really a tall order. And for the U.S. oil major to do that, they obviously need to see that the security is in place and they can reap a benefit or reap a profit from that kind of investment. And it's happening at a time where their own domestic market is struggling a little bit with the current low price at WTI, where the revenues from that is not going to be as high as potential to justify these massive investments. So in terms of time span, we're definitely looking in maybe 1, 2, or maybe even 3 years down the line before we can see a meaningful pickup. And I think at that time, the glut that we're talking about now and has been talking about for a long time will have disappeared. And at that time, we probably need all hands on deck, and we need all the oil we can get in order to ensure that we don't have a shortfall. So the dream of much lower prices based on this, I think, is far-fetched.
In terms of the reaction we're seeing this morning, Ole, is the bigger reaction in gold and silver? And if so, what message are you taking from gold and silver?
Hi, Guy. Yeah, absolutely. We're seeing gold up 2% and silver close to 4%. Basically, continuation of the extreme bullish move we saw last year, where gold more than doubled and silver went up more than 200%. That is probably the proper reaction function, because this is heightened geopolitical risks. What kind of signal is this sending to China and Russia in terms of their territorial aspirations? And the market's just simply worried that this is breaking down some of the rule-based system that we're used to, and the market is trading back into these precious metals as a way of being cautioned about, or sending a signal that they're somewhat worried about the geopolitical ramifications of this.
Yeah. Does it continue?
The metals, I think they will.
Yeah.
There's been a lot of speculation that about various ways, various drivers in the market, but I think as long as the reasons why gold is up here does not disappear, and I don't see any signs of that happening anytime soon, then I see no reason why we shouldn't make a move up to at least up to 5,000. Silver has probably run a little bit ahead of itself, but it is a market with where the outlook right now points to extreme tightness in supply. The same goes for platinum, and that will potentially continue to see these two metals outperform gold. So yes, I think it's not time yet to switch all your money from metals into energy.
Well, so 5,000, good morning, 5,000 by the end of this year, is that the time frame? And what are the key catalysts? I mean, clearly geopolitics is the catalyst now, but it was central bank buying, it was ETF flows in 2025. What drives that to 5,000 by year end, if that is your target?
The prospect of lower rates in the U.S. maybe at a time where the economy doesn't really justify it. We're seeing the steepening yield curve in the U.S. with the 230 at the highest level in a number of years. The 210s is also chasing higher. That is sending a signal that the market is somewhat concerned about the fiscal debt situation as well. The interest payment this year is going to exceed $1 trillion on par with probably this military spending, and there will be questions raised throughout the year where the funding is going to come from. So I think that uncertainty is creating the underlying demand. And with what we're seeing here with Venezuela, the central bank demand, which is partly driven by de-dollarization and moving away from dollar-based assets, that will probably only be strengthened by this move. So I think basically still points towards higher prices. The 5,000 target was made when we were trading quite a bit lower in gold, so perhaps it should potentially be even higher.
OK, potentially above 5,000. Before we let you go, Ole, briefly back to the oil story. What stops OPEC Plus simply cutting supply rather than just pausing, adding additional barrels?
Well, that would be the next focus. If we do see a slump below 60, if we start to move down towards the mid-50s, I could imagine that there will be increased speculation that they might step in and try to stabilize prices. But following this weekend meeting, there's no sign of that. They're obviously watching developments. But for that to happen, we probably need to see a slightly disorderly market. And so far, that's most certainly not what we're having.
Ole Hansen, Head of Commodity Strategy at Saxo Bank. Thank you. Fantastic insights, important insights on a day like today across the commodities space. Coming up, we're going to get more, of course, the market open. We are a little under 6 minutes away, with European futures pointing strongly higher by 0.7%. Stay with us. This is Bloomberg.
Monday morning, good morning. Today feels like back to school. So today's the kind of the proper first session, and we've got things to talk about. Venezuela, what's happening with AI. There's a lot going on this morning. It feels like 2026 has started with a bang. I'm not sure Friday's session was a real session. It kind of was a real session. It gave us some indications maybe about what was happening, but we hadn't got Venezuela to kind of factor into our thinking. So it kind of went a little bit sideways, to be honest. Europe went out about there. The US session finished a little bit high. I'm not sure there's much kind of a story to attach to that, but what we have now got is a really strong Asian session on the tech story, which I think probably is the narrative that Europe is going to latch onto this morning, Tom.
Yeah, the equity market's already moving ahead to the AI theme. We have CES, of course. We've got Jensen Huang speaking later today ahead of that CES event in Las Vegas, but it's the upgrade from TSMC. That was a key catalyst for the Asian shares, and gains of around 3% for the Nikkei and the Kospi as well, between 2 and 3%. And to your point, Guy, that is feeding into a very bright pitch when it comes to European futures, pointing high by 0.8% on the benchmark Stocks 50 futures. Here in the UK, FTSE 100 futures, after a very strong year for the FTSE 100 last year, of course, outperforming their European counterparts, looking to add 0.6%. DAX futures over in Germany looking to add 128 points, pointing high by 0.5%. Again, watch the read across to some of the chip names in Europe. Anna.
Yes, indeed. We'll keep an eye on the tech stocks. We'll also keep an eye, Tom, on what's going on oil stocks this morning. Maybe this is more of a US story. Maybe we'll be watching Chevron go higher at the start of the US session. But here in Europe, we have some European players that have some at least legacy interests in Venezuela, the likes of Repsol and Eni, with at least historically some exposure there. So we'll certainly have a look at what goes on with that sector. Bridgepoint, in focus in the private equity space, reports of a deal there. Orsted and Equinor taking legal action against what they are and are not allowed to do with wind farms in the States, Guy.
OK, here we go. big session coming up. Tech's going to be a big story as we watch this European market open. Keep an eye on the airlines this morning. Keep an eye on the defence stocks. Keep an eye on what is happening with the oil sector. FTSE 100, as Tom was saying, out of the gate quite strongly as we see it up by around circa 0.5%. Stock 600 rising a little bit this morning. Let's wait and see what happens with the CAC 40 and the DAX this morning. There's interesting tech trades that we need to factor into our thinking. What's going to happen with ASML this morning on the back of what we've seen out in Asia? That could be a big theme as well. The IBEX, the big outperformer of 2025, starts 2026 up nicely on this Monday morning. I know it's already had a few sessions, but this is the kind of first real session. We're up by 0.4%. The CAC is up by 0.6%. The FTSE's up by 0.6%. So a solid start. But sector composition, I think, is really going to matter. Where are we seeing the outperformance this morning? Let's find out. Tom, what are you seeing in the sector story?
Right now, across the sectors, basic resources gaining around 2%. Top of the list so far, but of course, the print's still coming through. On the downside, personal care down 0.1%. Just two sectors so far in negative territory and not by much. Most of the sectors, then, the vast majority in positive territory. Tech, as expected, then, as a sector, gaining 1.3%. There's the energy story as a sector up 1.1%. So tech, energy and basic resources charging ahead in the session so far today, and some individual names, of course, jumping out, Anna.
Yeah, it's really interesting to see basic resources do as well as it is this morning because you've got copper prices doing well. Part of that's the supply narrative we covered a lot at the back end of last year, but it's also about risk on, about animal spirits, and that was certainly evident through the Asia session, and that seems to be lifting things. I wonder if that is partly the driver behind what we're seeing in energy as well, because the oil price is down, and yet some of the energy names not with any exposure to Venezuela are higher this morning, up by more than 1%. So it's interesting to see that wide push higher for the energy space.
So energy's kind of a theme this morning. Like Shell's the same points story. Shell's the second biggest points gainer, up by 1.26%. ASML's the biggest points gainer, but defence stocks are up this morning quite strongly. Look at names like Leonardo, look at BAE Systems, all up. Again, maybe we need to start putting the defence names in the same bucket as gold. You see that kind of geopolitical tension story coming through. You buy gold and you buy defence names. An expectation maybe of higher defence spending moving forward from here on the back of all
because
of
it
this.
took no time between the seizure of Maduro for many market voices to start asking questions about where's next. Is this all about the Western Hemisphere? Is it all about the Caribbean? Or does this start to be about Greenland? Does this start to be about China even? Is this going to provide inspiration to other parts of the world?
Does it empower China when it comes to Taiwan? Does it empower Russia in terms of its ambitions, continuing ambitions, of course, in Ukraine? Rheinmetall, to your point then, up 5.4%. Leonardo up 5%, Renk up 4.7%. So the gains are really strong across the defence space, Guy, as you were saying. Let's bring in a view then, a deeper dive in terms of the equity space, and bring in Jerry Fowler, Head of Global Derivatives and European Equity Strategy at UBS. Jerry, do the moves that you're seeing so far in the session make sense? How do you play this?
So I think a lot of what's happening in the market at the moment makes sense when you think about the macro drivers of the way markets move, which is really just flows of CTAs, of risk control funds, of buybacks, of pension savings, which are largely still net inflows into the market. And then also, particularly in Europe, I think a lot of people don't realise that the European market day to day is very driven by what the pod hedge funds do. What they tend to do at the single stock level is they follow earnings momentum. So there's a lot of investors today who are basically saying, I think the earnings revisions for the defence companies are going to be going up, and so I'm willing to reprice those shares by 5%. Now, I personally don't think that's going to be the case. I'm not sure that those earnings revisions for those defence companies are going to rise anytime soon, because they're already pretty lofty, and they do need to deliver on those expectations, and we're yet to see that. It's coming through this year, but we need to see it before we get further analyst upgrades that will drive further enthusiasm to drive those stocks higher. So it's certainly not a negative view on the defence spending beneficiaries that did derate pretty aggressively since last summer. It's really just a view that there are easier options where earnings revisions are continuing to look quite strong, quite positive. Things like renewable energy, electrification, European banks, just much easier plays at this point.
What would you do with the energy space and basic resources on a day like
So
today?
we actually upgraded energy with our outlook. So today that's probably not looking so hot right now. But it is going to be quite interesting to see, because our energy analysts are of the opinion that it's the margins that is working for the European energy companies. That's part of the reason why those energy companies are going up quite strongly, even though the oil price has been going down. So it is a little bit about the quality of the investment and the R&D and the capex that's being put into the ground for these European companies.
And they're driving higher margins despite lower oil prices.
Correct. So they're actually able to expand their margins anyway. And actually, if we take a little digression, I think that's really one of the big themes about what's happening in the macroeconomy relating to AI as well. Because it's interesting that normally when you see companies cutting jobs, it's because their sales are under pressure and they're trying to protect their margin. What's interesting in this cycle is that we're starting to see some firms announce job cuts related to technology, some of it maybe AI, probably a little bit early. But that's not necessarily to protect margin because their sales are weak. It's to expand margin because they've got the opportunities to do that. So it's going to be very interesting to see how the market behaves when you might have jobs weakness at the same time as margin expansion and earnings growth. Equities are priced off earnings.
Because sometimes that reaction, it seems cruel, but understandable. Yes. When you get job cuts announced, you see stocks go higher because people say higher margins, but you're saying it's more complicated. It's going to be more complicated than that in 2026.
Yeah, ordinarily you get this demand-driven recession that causes firms to cut jobs, and in this case it's not. It's just, even at the European conference that UBS held last year, I just noticed that the language of many companies who were presenting was around margins and productivity. Even if it wasn't specifically relating to AI, the AI conversation around productivity is just causing lots of companies to focus more on productivity than specifically top-line growth or anything else.
Yeah. You mentioned defence, and you were saying, there's a lot of money that's just making this assumption that maybe we get higher margins, and that's... What else do we need to... Given that it is the 5th of January, Jerry, what else do we need to know about the way that the markets respond at the beginning of the year, the mindset, I suppose, that investors bring at the beginning of the year to try and set out their stall for the weeks ahead?
So most of those flow arguments I was making around CTAs, buybacks, etc., those are pretty reliable flows into the market, positive or negative, but at the moment net positive, and most of the time net positive. But for a lot of the risk takers who are moving stocks day to day, they really want to close down their books into illiquid periods like Christmas. So we have seen a little bit of weakness in some of these trades in the weeks leading up to Christmas and through Christmas because it was just a less liquid time. So now we're back and everybody's putting on the same trades they had on because it's like, right, I can put them back on again because I'm confident I can get out of them. The liquidity is there.
Yeah.
Where else are the pod shops wrong?
So we tend to only push back on market movements once you start to see both high valuations and crowding, but that's not enough. You do need to see the driver of the momentum and the positioning start to dissipate, and that is earnings revisions. So for a long while, in fact, since last summer, we've been talking about defence spending being one of those vulnerable sectors. Very crowded, very expensive, but really has not had upgrades to lofty growth expectations for 6 months. So that's one, but I think there's been a pretty significant clean out of that in the last few months. There are a few other interesting ones as well. I mean, we do rate ASML as a buy. It's a very good company. It will be growing very strongly. But the shares rallied 50% since our analyst upgraded in September, and yet the earnings aren't being upgraded 50%. So it's simply a re-rating that has taken that stock back into the mid-30s of, in terms of PE ratio. So there's some vulnerability there as well. On the flip side, you've got something like SAP, which actually hasn't had a particularly significant downgrade. It just got expensive and crowded. It wasn't getting upgrades. It was, therefore, in need of a bit of, retracement. And it's come back a long way now. But actually, that's one of the companies where we think there is quite a lot of opportunity for AI-driven productivity. We're seeing that in its sales per employee. We're seeing that in its margins already over the last few years.
Europe or the US?
Very good question. I think it's really interesting that US investors, so distracted by the new government in the US for the last year, haven't noticed that the rest of the world is already outperforming. And the themes that were led by Nvidia and semiconductors have already broadened to renewables companies and cables companies in Europe and defense companies in Europe and memory companies in Korea. Korea was up 100% last year. So there's a lot going on in the rest of the world that already outperformed, particularly in
that continues into this,
particularly in a dollar basis. Obviously less if you don't include the currency. But absolutely, I think those are the trends for this year because while you can get some broadening in the US, the leadership of those large companies at the valuations must come from revenue because they're already high-margin companies. So yes, they're growing revenues at double-digit levels. They're growing incredibly quickly. They are still quite appealing investments for that purpose. But you get a lot more operational leverage through the margin expansion, therefore potentially even faster earnings growth outside of some of those US companies into Europe, particularly into Asia. My concern as a European strategist is that Europe might just get overlooked. Yeah, my view is that Europe goes up 10% this year. I'm pretty confident of that. I think there's probably risk to the upside rather than the downside on that number. But, Asia might go up more, in which case, Europe just still languishes as not the market that's hot right now.
Where does the UK sit in your view then? The FTSE 100 outperforming, up 20% in 2025, outperforming the S&P 500 and
so
European counters. Can that continue, that divergence?
It can. I mean, the FTSE is a very funny market because it's so internationalised and therefore very dollar sensitive. It's a mix of highly cyclical companies like banks that we like, as well as some energy and mining, but also some defensives that we don't like household and personal products and even pharma, which we're more neutral on. So it's quite balanced. What I found interesting was that Keir Starmer is talking about closer alignment with Europe. So there's potentially some room for re-rating from cheap valuations, particularly for smaller and mid-cap companies.
But what specifically in that relationship would need to change for that re-rating?
Well, I think just closer trade would unlock some of the underperformance that we've seen and the de-rating we've seen in the small and mid-cap space in Europe that's a bit less sensitive to currency, a bit less sensitive to oil, a bit less sensitive to global dynamics, more UK-specific. Those small and mid-cap companies have really languished from an earnings perspective for a long time, but they have been improving in the last couple of years, and the valuations are really very cheap. So there's a lot of room for those companies to benefit if there is new enthusiasm in that space. Yeah. The problem is small caps globally are just not the flavour of the month. And unless they garner flows and consistent flows from pension savings or whatever it happens to be, the re-rating is just not something I would bet on.
Politics and its influence on markets is everywhere, and we talk about it often, Jerry, and yet you talk to us about global renewables and how this is an area of focus. We have other guests who say, this is a theme that they're leaning into, and yet we know that the US administration does not feel very kindly towards that sector. But what does it tell us about the way that the market can look through that political risk or find opportunities regardless? Because it is an area that's done well recently.
Yeah, it's just to paraphrase somebody else, I'm not sure who said it first, but there's a real need for electrons, and it really doesn't matter where they come from at this point. So in the US, for example, the data center build out at the AI conference that UBS held last year, I was going into all the specific areas where there could be supply constraints. Energy is obviously one of those. A lot of those data centers are now getting off-grid energy. Ideally, that is gas, but you can't get a gas turbine for a couple of years because they're sold out. So if you want to build new marginal capacity, what do? You've got to put some renewables in, you've got to put some batteries in. There are data centers that are using old aircraft engines to generate energy at the moment. So there's so much need for energy at the moment that renewables are really benefiting from that wave, as well as obviously politically driven investment in Europe as well.
Wow. Old aircraft engines.
That got guys' attention.
Love that.
Yeah.
Did not know that.
They're quite expensive to run.
Yeah. This
But this is where China
sounds like a
has
story we should send you to cover, guys.
But this is where China has the advantage. China's got all the electrons. The US doesn't. The US has got the chips, but China doesn't.
Yeah. China doesn't have the oil, but it has the renewable energy infrastructure.
But it's also built the power stations.
Yes. And it has a nuclear power.
And
it's exporting.
So it's really interesting to see which one of the factors is going to be the critical factor.
Well, the real thing we ought to be nervous about is fusion, which is really not far away because AI might be the thing that enables fusion. Google are working hard on this, and if we get fusion, it won't be grid scale anytime soon, but it could be data center scale, and that could be a bit of...
This is a 2030 story, is it?
Possibly 2028. There are companies that have committed to delivering commercial fusion by 2028. Helion, CFS. So there's some interesting stories there that might completely change the game, but it's getting a lot of investment, a lot of attention.
Sam Altman is connected to Helion, I believe.
Correct.
Yeah.
Wow. Okay. That's a game changer. Jerry Fowler, Head of Global Derivatives and European Equity Strategy at UBS. Thank you very much indeed. Let's take a quick look at the Core 6 before we get too far ahead of ourselves. Let's see what's happening in Europe this morning. The kind of duller end of the market, I'm not going to call Nestle dull, but that is the safer end of the market, I'm not even sure it's safer, is down this morning. As you can see, defence is definitely up, which is interesting. That trade is on. Gold is up, defence is up. That's an interesting story. But the standout story out of Asia was tech, and you can see it in ASML this morning. Look at that, up by over 4%. Blistering performances out of Asia being replicated here in Europe this morning, despite what Jerry just had to say, maybe about the re-rating that we've seen. Let's check some of the individual stocks that we are watching in the defence space, more specifically. Chloe's here with that.
Good morning, Guy. Of course, the Venezuela situation is dominating the news, and we are seeing this impact across different sectors, and defence in particular. Of course, we've got heightened geopolitical tensions, and that means that investors are piling into those defence shares. We have seen Asian defence stocks already moving higher, and we are seeing the same for those European defence stocks as well, with Rheinmetall in particular up 6% this morning. But we are seeing a really strong showing across the board for that defence industry. We're also seeing a positive movements for miners. So we have we've got a similar dynamic here with investors rushing towards a safe haven assets like silver and gold. And of course, that is very beneficial for those miners, in particular a silver and gold miner like Fresnillo that is up almost 5%, but then also Rio Tinto, Glencore, Anglo American. All of that is green across the screen this morning. Moving on to chemicals, and Morgan Stanley has said that industrial chemicals will be in quite a tough spurt for 2026, but that there's winners and losers within that. And Ciensco, in particular, is actually a winner, and it is a top pick for Morgan Stanley analysts, and that is driving that stock this morning up 4.5%. And finally, Eurofins Scientific, which is a lab testing company, is also up this morning after being double upgraded by BNP Paribas, saying that the company was now in a sweet spot of higher margin and higher growth as well, after kind of moving on from some governance issues that had been plaguing it for a few months. And so we are up 5.4% for that company this morning.
Chloe, thank you. Our equities reporter, Chloe Melly, the equities team back with us for 2026 as we continue to chart these markets. 8:15 here in London, so 15 minutes into this trading day on the 5th of January. Coming up on the programme, we'll take a look at the oil market and what the US capture of Venezuela's President Nicolás Maduro means for the industry's biggest players here in Europe, over in the United States. That conversation is next. This is Bloomberg.
Monday morning, good morning. How are we doing? We're doing quite well. If you are long stocks, you're having a pretty good morning. European stocks are up. Tech is leading. SML's having a pretty good day. You've got some of the mining stocks doing well. Oil and gas and gold and silver and platinum. That kind of trade is definitely on this morning. But actually the one that maybe caught me a little bit by surprise this morning was the defence names. They did well out in Asia, and they're definitely doing well in Europe this morning as well. Very much on the front foot. An expectation as the world changes, maybe that more gets spent in that space. Crude looks a little bit like this. So let's kind of figure out exactly what is happening in the hydrocarbons market. As you can see, Brent crude, TI, both moving to the downside this morning. Oil stocks are up. Oil itself is down, which is kind of a weird kind of situation this morning, but it kind of makes sense when you think about it. Venezuela's oil production currently the big story. It's currently at around 1 million barrels a day. I've seen numbers this morning saying it could produce up to 5 or 6 million barrels a day. But how does that actually work? The US President Donald Trump says he needs, quote, total access to the country's oil assets. Let's take a look how the US capture of Nicolás Maduro may recast the energy industry within Venezuela. Mitchell Furman, who covers European big oil companies, joining us around the table to do just that. Chevron looks good. It's been in there for a while. It's likely to be the biggest gain. I'm fascinated to see how Chevron opens this morning. What about European names?
Yeah, as you mentioned, Repsol, Eni, these guys are in Venezuela. They have positions. They've been there for some time. And so those positions give them a bit of a foothold. They're producing small volumes right now. Repsol and Eni have a joint venture.
Put those together.
Yeah. They have a JV in a gas field, and so there is prospect for them.
OK, and what could it mean for US oil and gas giants? Because already the conversation from the president, from the US administration has turned to talking about oil and the opportunities that exist in reshaping the oil sector there. Is it all about Chevron?
Chevron is undoubtedly the winner at this point. They've been there for a century, and they know how to operate there. So they have an advantaged position. Other companies, it remains to be seen. Exxon has been there in the past. ConocoPhillips has been there in the past. Their assets were nationalized in the early 2000s. They have yet to say whether they're interested in going back. ConocoPhillips actually is still owed about $8 billion from Venezuela for the nationalization of those assets that a judge has ruled that they are owed, so they still need to collect that administrative fee.
Yeah, wasn't Exxon is owed about 10 billion as well? So what, collectively 18 billion between Conoco and Exxon? Do they look to get that back, given the changes that we're seeing on the ground in Venezuela, or is that still a long-term prospect?
Exxon has been paid. Conoco still is owed their money, and so how that translates to actual operations is still in question. Conoco said over the weekend it's way too premature to evaluate possible business opportunities, but they are among the world's largest explorers and producers. So, any opportunity where there's big reserves, they will be taking a look.
Okay. Mitchell, thank you very much indeed on some of the corporate names and the impact. We didn't get time to get onto China because they have exposure as well, and China's been coming out saying they're going to continue cooperation with Venezuela, see what that looks like as well. With a deep dive of some of the corporate names and the impacts as a result of the changes on the ground in Venezuela. Let's switch focus now to the other commodity space that is moving, and pretty dramatically in terms of silver and gold prices, as you can see on the screen there. Gold up more than 2%, silver gaining more than 4%. On the back of the geopolitical risk around Venezuela, trade uncertainty, of course, spurring buying following the US capture of Maduro. Let's bring in metals and mining reporter Martin Ritchie. Martin, talk us through the gains then and whether or not this is likely to be sustained when it comes to gold and silver, that both had, of course, remarkable years in 2025.
Yeah, that's right. A remarkable end to 2025. In fact, a real precious metals frenzy over the last sort of second half of December, with silver, gold, platinum, palladium all surging. And look, the action today and the events in Venezuela, I think they really sort of cement what's happening in the gold and the precious metals space. We have the big take on the terminal today saying, that Trump's move in Venezuela shows a new world order emerging. And I think in that context, with geopolitical risk and geopolitical uncertainties very high, this is the kind of environment in which gold usually and typically benefits. And so we're seeing that already this year. And a lot of the factors that were driving the market last year, because of that, will remain in place this year. Central banks buying more to diversify their assets away from the US dollar, perhaps private investors looking more exposure to gold and precious metals because of concerns about the US dollar or less faith in sovereign debt. So the balance of opinion is certainly that at this early stage of the year is that things are set for gold to stay strong at least this year.
Okay. Martin, yes, with that in mind, I mean, Goldman's base case is, $4,900 a troy ounce. So that suggests they expect at least for it to go higher. We're at 4,400 right now. Are they in the majority? Is that the majority view?
I think I would caution slightly against using forecasts that were produced, more than 2 weeks ago. To be honest with you, the environment has changed so much already. But yeah, I mean, taking that's a fairly kind of standard forecast for gold. I would say there's very few bears around who think prices are going to fall in this kind of environment. But what I would say about what Goldman had said was that there was upside risk to that 4,900 if there's even more flows by private US investors into exchange-traded funds. Investors are not particularly exposed to the gold price. If they choose to do so in much larger numbers, that will have a fairly outsized influence on the gold market. That's the kind of the very bullish case for gold.
I think the gold story is interesting this morning. Martin, I think the real story this morning is what's happening in copper. The AI trade is on in Asia, and it's rippling through into Europe as well this morning, and copper is the commodity version of that trade. Again, kind of, what are you hearing? Is it, again, all on into 2026?
There's no doubt that the AI trade has been very beneficial for creating a kind of positive mood in copper, especially in the second half of last year. A lot of people pointing to that as a reason for copper demand to grow even more strongly. I think there's a lot of cautious voices around in that as well. They say, look, data centers and the infrastructure are really not that big a deal for copper. Yes, it's incrementally important, but it's not that much. And the risk is that if the AI stocks rally stalls, then copper will too. So that's Martin, one of the risks to watch out for in copper.
OK, thanks. Martin Ritchie, this is Bloomberg.
Welcome back to the opening trade. 30 minutes into the Monday session then, and risk on across these equity markets. The geopolitics, the remarkable events in Venezuela, if anything, proving a catalyst, particularly when you look at the defence stocks coming through, and the DAX gaining on the back of that. Some very strong gains for the likes of Rheinmetall, up 0.9% then on the DAX. The broader benchmark here in Europe gaining 0.5%. Basic resources performing very well as a sector. Copper prices are up, and you're seeing gains for tech as well. There's an upgrade for TSMC. ASML performing very strongly on the back of that as well. The read across in terms of the AI theme is certainly there. The CAC current over in France getting 0.7%. The FTSE 100 here in the UK adding 32 points. Guy.
More stocks up than down. I think you can probably tell that from Tom's chart. 362 up, 228 down. What is back with a bang is volume. As you can see, we are definitely on the front foot when it comes to volume. It feels like the first day of school really today, and that I think is being shown up in terms of the volume numbers that we are seeing. Tom just mentioned some of the names that we are watching. Here are your leaders. ASML, tech's doing well. That's the trade that's come out of Asia into Europe this morning. But in some ways, you've got this kind of gold defense story as well. So gold is tracking higher as geopolitics, and the tension that is in geopolitics right now is manifesting itself. Rheinmetall, Rolls-Royce up this morning. The defence names are up. The lesson maybe for Europe this morning is you have to spend more, and that is likely to continue. But these stocks did incredibly well in 2025. The more cautious end of the market, a lot of it's in Switzerland this morning. Nestlé, Novartis, Roche, all of these stocks are down this morning. I'm not sure there's a Swiss link. I think it's just more of a defensive end of the market, ironically, is where the pressure is. So Nestlé down by 2.2% in Verve, but Novartis and Roche also down as well. It was interesting listening to Jerry Fowler of UBS a little bit earlier on, again with the Swiss link, talking about the fact that maybe some of the pharma names don't look that good going into 2026. That's certainly being evidenced this morning in terms of the names that are down this morning, Anna.
Yep. Guy, let's get an update on some of the other stories that we're covering this morning. Ukraine's President Volodymyr Zelensky says US negotiators will join European leaders in Paris on Tuesday in the latest effort to hash out post-war security guarantees for Kyiv. Zelensky added that the talks could last a day or two and that Ukraine hopes to set up a meeting in the US at the leaders' level by the end of January. President Tayyip Erdogan has told Bloomberg that Turkey's re-entry into the US-led F-35 fighter jet program is key to NATO security. The comments highlight the Turkish leader's bid to use his rapport with President Trump to repair ties strained almost a decade ago over Turkey's purchase of Russian-made air defense systems. And Bloomberg has learned that China's top financial regulator has asked its policy banks and other major lenders to report their lending exposure to Venezuela after the US ousted the South American country's Beijing-friendly leader. Sources say the National Financial Regulatory Administration also urged banks to strengthen risk monitoring of all Venezuela-related credit.
Yeah, Chinese leaders, at least senior leaders, were on the ground in Caracas just hours before those US strikes. And a reminder, of course, that China has exposure in terms of energy, gas and oil commitments in Venezuela, but a lot of lending as well, to which, of course, they've been taking Venezuelan oil partly as payment to that. And that ties into today's Bloomberg Big Take, which says that Trump's ousting of Venezuelan President Nicolás Maduro shows his new world order is here. Joining us for more on this and the global reaction to the weekend's events is Bloomberg Opinion's Mark Champion. Mark, are we at the forefront then of Trump's new world order? Is this what we're starting to see with this action in Venezuela?
I think absolutely, especially in the sense that, the order that we had, the one of international law, of, as kind of globalization as an idea, this is a very signal event that just sort of says, we all knew this was coming, we all knew it was happening, but it's over. And that makes it sort of particularly difficult for the Europeans who have really constructed their lives in a much more concrete way around this. The EU is a real expression of that kind of order. And you hear it from, some of the leaders and things that they said today. The French foreign minister being particularly outspoken, a lot of the other leaders being very careful and quiet because they still depend so heavily on the US, which was the fulcrum of the old order. So very hard for the EU, but I think it's quite clear that we're in a different place. What exactly this new world order will look like, I simply don't know, and certainly Donald Trump doesn't know. He's acting very clearly the way that he perceives to be the interests of the United States and his interests. But that doesn't necessarily constitute a world order or any kind of philosophy about what that should be.
And maybe that also relies on how other countries respond to this new order, whatever it looks like, Mark. So which of the areas of the world or countries should we focus on then if we think about where should be on high alert? And you can define that how you want, not necessarily the capture of their leader, although maybe that might be possible in certain parts of the Western Hemisphere. But where should we be focused?
Well, I mean, clearly, because the president himself has name-checked it, Greenland will be concerned, and therefore Denmark. And the Danes have been out there saying, you know, you have no right to take Greenland from us. You know, and that, again, speaking to international law, which is really the only tool that Denmark has, you know, if it came to any kind of military confrontation with the United States over Greenland, is no guesses as to, you know, who comes out on top. So
it's just remarkable that we're even talking about that.
It is
a potential military confrontation between Denmark and the United States.
Both in NATO.
Both in NATO, and long-standing
we are seriously discussing that today.
Yes.
And we haven't actually seen, for obvious reasons, NATO members come close to fighting, although there have been sort of skirmishes. I think Greece, Turkey, Iceland, Cod Wars and these things, but they've never really, that's never been at the on a scale that would be prompted by something like
and part of the
Greenland.
Absolutely, and part of the sort of the idea behind NATO was to solve some of those problems, right? To solve some of the problems between Greece and Turkey. It was quite specific. But you know, going forward, I mean, NATO hasn't collapsed. The United States is not sort of you know, pulled away and declared itself, you know, that it's not interested in having any allies in Europe. I mean, we're some distance from that, but it's very clear that, you know, the assumptions that could be relied on are no longer reliable.
Okay. So if Venezuela's in the US's sphere of influence, is Taiwan in China's?
Well, China will certainly see it that way, and you know, how this plays out is going to be really interesting, because it's clear, you know, that the way that Trump sees the world is very similar to the way that, for example, Vladimir Putin sees the world. Spheres of influence, you know, he even used language that was very similar to Putin's when he said, you know, it is the duty and right of every country to protect its economic and other interests in other countries, right?
Yeah.
You know, wherever they see them. And this is how, you know, Putin says, he said, we're not attacking Ukraine, we're protecting our interests in Ukraine. And it's very similar language. So, you know, for the Russians, this is, you know, at least at a sort of rhetorical level, this will be quite welcome. And I mean, I don't mean that the Russians will say we love this, but what I do mean is that they will feel like, okay. And in fact, President Putin, in a speech at the Valdai Club in, I think, October, he said quite clearly, you know, the Americans are, you know, very clear about what they want, and it's quite aggressive at times, and it's quite, you know, blunt, but at least there's no more hypocrisy. Yeah. We all agree that it's about national interest. And so that, I think that will be largely the Russian response, and they'll hope to be able to leverage that in some way over Ukraine. The Chinese is going to be much more complicated. The Chinese, remember, also bought in quite heavily and strongly to the kind of US-created world of globalization. And that's what the Belt and Road's all about. That's why they had people in Venezuela, why they have investments in Venezuela, why they're present everywhere. So for them, it is a more complicated thing. And also, you know, the US, because of the chips in Taiwan, even, you know, Trump will be... have people telling him you can't just give it up because, you know, this is where our chips come from.
Big supply chain story.
Absolutely. So it's messy.
Mark, a lot more to think about. Mark Champion, Bloomberg Opinions, Mark Champion, on some of the big thoughts going into 2026. Let's carry on the conversation. Robin Niblett, distinguished fellow and former chief executive of Chatham House, joining us on the line. Robin, you listen to that conversation. It feels like the world is changing. It feels like we are entering, or maybe we're leaving a world order that we understood and entering a world order that maybe we've still got to get our arms around. How are you thinking about this?
Well, good morning. Yeah, it is quite a way to start 2026. I was listening to Mark's comments, agree with what he was saying. Look, there is no new world order, and that suits Donald Trump very well. I think he saw the old world order, the one of alliances, one in which America was invested in a system of globalization, of having to take care of partners around the world, as constraining American influence, constraining America's room for maneuver. And what he's done is basically broken that all apart and said we're better off as a country that, because we're the strongest, can take advantage of a world that doesn't have rules. I'm struck by his rationale around the Venezuela capture of Nicolás Maduro. It goes 1 minute it's about drug running, the next minute it's about getting oil in there and extracting the oil. So he doesn't even need a reason to do it. So I think in that sense we have not obviously entered a new world order. It is the collapse of the old one. And it is one in which the United States, at least under Donald Trump, feels it has maximum room for maneuver.
Robin, a lot of investors will look at this and say, I can ignore it. Geopolitics has an impact for a few days and then we can move through it and move on to something else. Do you think that's the right approach? Do you think that some of the tectonic shifts that we are seeing will have longer-lasting implications that are still unquantifiable at the moment, and maybe that's the reason I can't price them in, is because they're unquantifiable, but will have real impacts on economies around the world? How do you think investors should view this world?
Well, I think, look, I caught the very tail end of your market analysis this morning, talking about European defense stocks being way up. This is having real-world impacts into markets. For the simple reason that everyone's going to have to take care of themselves. The globalization as we knew it in the past, and some of your stocks were down, I saw Nestle on there, stocks that had relied on an integrated global economy, minimum friction costs, maximum room to be able to take advantage of supply chains on an efficiency basis, not on a resilience basis. That is over, number one. Number two, I think we are moving to a bifurcated technology world. So, China, US, it's stabilized, certainly. It seems to me to have stabilized the relationship at the moment. Donald Trump has got a summit meeting coming up in China in April. They'll have a couple of other summit meetings over the course of the year. He can personalize that relationship with Xi, try to keep it calm. But beneath the surface, there is a continuing and ongoing separation of the technology systems of the US and China. So at a minimum in those two areas, Europe having to take care of its own defense, that'll have an impact on markets, a much more fragmented set of supply chains around the world, that'll impact companies. Companies absolutely have to keep an eye on geopolitics. The problem is there's no shape. So they're really going to have to spend the whole time looking at trend lines rather than scenarios.
Yeah. And Robin, is there any shape to your expectations for Greenland? What should Greenland be prepared for? What should Europe be prepared to do in response?
Look, I think I was listening to Mark's comments about Greenland, and I would have at the top of my list of worries, certainly if I'm in a European capital. Now, there's a big difference between the Greenland proposition Donald Trump is making and what he's done in Venezuela. He is not trying to annex Venezuela. He has captured, a bit like George H.W. Bush did, certainly with Panama and Noriega, captured a foreign leader indicted for drug running in your own hemisphere. So Greenland, if he follows through on what he's talked about there, it's about annexation. And that is a very big step to take, never mind a very big step to take vis-a-vis a member of the EU and a member of the NATO alliance. So at the moment, I see that more as a pressure play. But clearly, one of my worries for 2026 is that the Europeans have spent all of 2025 buying time, making promises to Donald Trump that actually are not going to come to fruition in 2026. We're not going to be buying $250 billion worth of oil and gas, which is what was promised at the Turnberry summit with Ursula von der Leyen back last July. We're not probably going to be investing as much as we said. There are court cases going on against big US tech companies on the Digital Services Act. So, the relationship between Europe and America could get very nasty this year. He may, put some tariffs up in that space. And that aspect of geopolitics is one companies need to keep an eye on.
Right. And Robin, with that same question in mind, does this have read across into Asia? Does this have read across into the relationship between China and Taiwan?
Yeah, clearly, as Mark was saying as well earlier, I think for somebody like Vladimir Putin, this is like, hey, what I'm doing in Ukraine is the same as what Trump is doing in Venezuela, not letting foreign powers get a toehold in our own hemisphere. But China takes a much, much longer term view of these questions. Could they take Taiwan militarily? Probably, by destroying it, obviously, in the process. It would be a high-risk move. But China wants to win Taiwan by making Taiwan, in a way, accept its own absorption into China. That is a sign of the strength of the Communist Party of China. Having to do military interventions is a sign of weakness, never mind one that would create great instability for the Chinese economy. Russia can get away with a world on fire because it sells oil and gas. People buy it under any circumstances. But China needs a stable world to be able to access its imports and sell its exports. So China, I think, will be a lot more cautious, even though Trump has set the template here.
Robin, what are the likely constraints on Trump as we lead up to the midterm elections at the end of this year? Do domestic politics constrain him on the foreign policy side?
It seems to have constrained him on the trade part of his foreign policy. And obviously trade and tariffs were meant to be, and were for a period, the main manifestation of Trump's foreign policy. And we now have tariffs at roughly 8 times what they were in the United States on average compared to before he took office. But he has certainly rode back on some of the more extreme positions, for example, against Brazil, coffee, orange juice. These were really affecting the pocketbook. And so I think the midterm election worry, the slight impact on inflation has definitely constrained him. But it looks like that pushes him even more into wanting to manifest America first through his foreign policy. And Trump has famously said, America first is what I say it is. So I am concerned in a way that he is not going to be constrained on his more extreme parts of his foreign policy by the midterm elections. It is affecting his relationship with China, where I think, again, he wants to damp it down. And it certainly has helped Brazil in the near term. And it means he wants to keep oil prices low. So, again, he does not want a major conflagration in the Middle East, for example, that could push oil prices up. So, yeah, it has some constraint, but I think it's on the margins.
OK, timely analysis. Robin Idblett, distinguished fellow and former chief executive of Chatham House. Robin, thank you. Now, coming up, which chipmaker saw a 35% price target raise at Goldman Sachs this morning? We've been touching on this through the programming, so if you've been watching, you should know the answer. We're going to bring that to you when we come back. This is Bloomberg. Welcome back. Now, before the break, we asked which chip maker saw a 35% price target raise at Goldman Sachs this morning. The answer, TSMC. The shares then rallying on the back of that. The most, in fact, since April on that target change. TSMC raised by Goldman Sachs. The share move helped lead a broad charge, of course, in Asian tech stocks as investors plough more cash into the AI theme despite concerns of overheating. We've seen the read across to the likes of ASML performing very well as well. Goldman Sachs saying that the AI momentum will be a multi-year driver for TSMC. Anna.
Right, yes, and I like that Tom told us the answer to his question earlier in the programme. So, memo to self, always to pay attention to what Tom's saying, and I'll always get the answer to this question. Let's broaden the conversation, though, Tom, and get to Paul Dobson, our executive editor for Asian markets, who's in Singapore, and can give us some sense on how Asian markets have started 2026, how they're dealing with the latest geopolitical headlines. It's really interesting, Paul, to see that stocks are rallying here in Europe. It's defence names. It's also tech. Over in Asia, tech getting a lot of the gains. If this really was about a geopolitical re-evaluation and that pushed defence names higher, you'd think that maybe TSMC wouldn't be doing quite so well today, and yet it is. So clearly there is a lot of focus on the tech themes beyond geopolitics.
Yeah, definitely plenty of momentum there. Actually started at the back end of last week. The first day of trading in Asia was particularly strong as well. We had the Samsung CEO saying Samsung is back, and that was enough to lift the stock about 7% that day. We had a new company trading, BRun, which is a chip designer, and that went flying higher in Hong Kong as well. The market just gathering a lot of momentum. So we've got big gains again across the Kospi, and for Samsung, SK Hynix, those big names in the chip space, and particularly TSMC, which is such a huge part of the Asia index, really leading the rally. We have Goldman Sachs, as Tom was talking about, with that upgrade, talking about margins coming down, plenty of demand still fueling the rally in the company. And, in addition to that, it's not just about Asia, but also because TSMC is such a big part of the emerging markets gauge, we've also seen that go to a record high today, which is quite an interesting development, beating the last record, which was 5 years ago.
Paul, how much of today's market action can I pin on Venezuela?
I think very little, to be honest, Guy. My sort of sense is that, if anything, the market is kind of taking this as a reasonably positive development. Let me explain a little bit, because obviously the action is quite shocking in terms of how direct it was and unexpected. But on the flip side of that, the fact that the equity market is up. In fact, each time that Trump seems to do one of these foreign expeditions or actions, the market tends to rally on it rather than sell off it. So it seems like the market, is buying into the action that the Trump administration is taking to try to reshape the world a little bit and taking heart from it, rather than expecting there to be some big escalation that causes a long-term risk-off or hurt to the economy.
Paul, so given that, what derails this rally?
Yeah, so I think, well, if there were to be a dramatic escalation and more people were to come to sort of Venezuela's defences, then that may complicate matters in the short term. I think, at the end of this week, we have Nonfarm Payrolls, so obviously the Fed will come back into consideration to a certain extent. And then, the continuing concerns over the tech bubble. We get a lot of debt sales this week. I wonder how well they'll go and what that will tell us about demand for credit going into this year. But otherwise, it seems like the market is pretty happy with the direction that it's trading in at the moment, and that momentum is continuing to push through. One of the best starts to the years for stock markets that we've seen in over a decade, I think. So plenty of momentum still going there.
Paul Dobson, our executive editor for Asia Market. Paul, thank you very much indeed. Here's what else to think about then. Well, there's a lot more to think about this week, including a lot of data, of course, out of Europe, and then you have JOLTS data out of the US before we get non-farm payrolls on Friday. That's a big one, so we'll have a much clearer tell in terms of the health of the labour market by the close of this week. Let's bring in Valerie Teitel right now, our markets reporter, of course, in terms of what Val is watching. We've got the geopolitics. We've worked through some of that with Paul. Yeah. What else is your focus this week?
Look, non-farm payrolls is going to be a big one. It's actually the first time in 4 months we have a normal Friday payroll release at 1:30 with the normal month that it should be surveyed.
Nothing else about this week feels normal, Valerie, so that's good.
Exactly. Maybe some solace to the rest of the market that we are now resuming regular data, and I think the market is very much looking forward to a print without a lot of noise in it. Last month, we did see the unemployment rate tick up unexpectedly. If you look at what Bloomberg is surveying from economists at the moment, we are expecting to see the unemployment rate dip back down to 4.5%, so coming back down by 1/10. Now, that kind of narrative of, yes, maybe the labor market is weakening, the headline payroll growth isn't as much as the previous year, perhaps the market will still continue to believe that the Fed is on pause until further notice, until we see something fall off a cliff.
Jensen Huang or payrolls? Which you...
Look, the AI trade is very important. I think, obviously, the equity market this week has shown us that. And I think what CEO Johnson Huang is likely going to say could be kind of at least groundbreaking for what he thinks Nvidia's role will be in this next industrial revolution of tech.
Yeah, absolutely. So both of those in our sights for this week. Valerie, thank you very much. Valerie Teitel with the latest on what she's watching this week. Of course, the week ends with non-farm payroll. Still a lot of days to go till we get there. That's it for the opening trade. The Pulse is next. This is Bloomberg. Have a good day, everybody.